We are now looking at tax credits which reduce your taxes dollar for dollar. And we spoke about it. Let's say if you have a deduction above the line or below the line of $1,000, and let's say your tax slab, your highest tax slab is 35%. $1,000 deduction would help you reduce your taxable income by $1,000, would help you save taxes of $350. But if you have $1,000 tax credit, it would help you reduce your taxes dollar for dollar. So $1,000 tax credit would reduce your tax bill by the full $1,000. Now, when we look at tax credits, we'll talk about non-refundable tax credits as well as refundable tax credits. Now, non-refundable tax credits, they reduce your tax liability, but there would be no refund if the tax credit is more than the tax liability. If you remember, I gave you an example. I said, if your tax liability is $800 and your non-refundable tax credit is $1,000, Uncle Sam would tell you, see you next year. So 800 minus 1000 will be 0, not minus 200, because we're talking about non-refundable tax credits. However, if you've got refundable tax credits, in that case, if it's 800 minus 1000, Uncle Sam would actually send you back a check of $200. Uncle Sam would refund it if your tax credit is more than the tax liability. Now, when we're looking at tax credits, I'm going to tell all of you, I'm going to call you guys SDers, because you guys, you're going to be foreign business winners. Let's look at tax credits on page 81. On this page, we've got screenshots from the second page of Form 1040. We got Schedules 3 and 5. Let's look at line number 12 of Form 1040. Now, line number 12A is highlight child tax credit or credit for other dependents. And 12B is add any amount from, put a box around Schedule 3. On the right, draw an arrow pointing towards line number 12 and write tax credits non-refundable. Next, look at line number 17, which is the line for refundable credits. 17A, highlight EIC. So this one's the earned income credit. And then on the next line, you have add any amount from, put a box around Schedule 5. Now, line number 17 gets included in line number 18. So line number 18 says add lines 16 and 17. So draw an arrow from line 17 down to line 18. And line 18 is the line for underline total payments. So as you can realize, refundable credits are getting included on your Form 1040 as if it's a payment you've made to Uncle Sam. So on the far right, let's draw another arrow pointing at line 17 and write tax credits within bracket refundable and write treated as if payments made to IRS. Moving down on the page, put a box around Schedule 3 and highlight non-refundable credits. Put a box around Schedule 5 and this is a schedule for highlight other payments and refundable credits. Turn to page 82. And on the second half of this page, we're looking at non-refundable credits versus refundable credits. Highlight refundable credits, which are underlined included under payments on Form 1040. And refundable credits include highlight the child tax credit, where the refund is limited to the underlined additional child tax credit. Highlight American Opportunity Tax Credit, which is 40% refundable. And highlight the Earned Income Credit. Put a star there. One of the most important refundable credits. Let's move up on this page and try to identify the refundable credits amongst all the tax credits, which is ACE equals foreign business winner. Highlight the C of ACE because here is where we include highlight the additional child tax credit, which is refundable. Highlight the E of ACE because here is where we have highlight 40% of American Opportunity Credit being refundable. And highlight the first E of DEERS because this one's the very important. Highlight Earned Income Credit, a refundable credit. For tax credits, you gotta be ACE to be foreign business winners. And to discuss tax credits in a lot of detail, one by one, to this lovely mnemonic, let's get to the other side of my board. And as we go there, let's look at what we have here already. We got gross income here, all your schedules plus the mnemonic Sir You Owe. And then we had deductions to AGI, the above the line adjustments, your wishes to Uncle Sam. And I'm sure you still remember Mike, who takes interest in charity and casual outings. That's your itemized deductions from AGI below the line. So adjustments, itemized deductions, these are all deductions. Now it's time for us to talk about tax credits, which are a dollar for dollar reduction of your taxes. So tax credits are dollar for dollar, and you already have the mnemonic here. ACE foreign business winner. Let's start with the A of ACE. The A of ACE is adoption credit, and let me write that here. So that's adoption. So if you spend money on adopting a child, think about it. So you've spent a lot of money adopting a child. Now Uncle Sam is willing to give you a dollar for dollar reduction for the amount that you've spent in adopting the child, and that is adoption credit for you. On page 83, on the top we've got adoption credit, which is right, the A of ACE equals foreign business winner. Adoption credit is highlight the credit for expenses incurred in adopting a child of less than 18 years. eligible expenses here are underlined all reasonable and necessary expenses, costs, and fees, but not medical expenses.
The C of ACE is child tax credit. So what we have here is child tax credit plus there's also credit for other dependents. So if you have a dependent child who's less than 17 years old, so the criteria here is less than 17 years old, and you meet certain requirements, you would be eligible for a child tax credit. Now, other dependents, a dependent relative or a child who's grown up could qualify for credit for other dependents. So this is the benefit that we spoke about when we talked about qualifying child, qualifying relative, and how they could get you credits, help you reduce your tax bill. Now, certain portion of the child tax credit is refundable, and let's look at all of this on a book.
Back on page 83, we are looking at the C of ACE, which is a child tax credit and credit for other dependents. Right? C there. Highlight child tax credit, which is up to, put a box around $2,000 per child. Now the child needs to be, underline a qualifying child. Circle plus meet the following additional requirements. So number one, underline age limit is 17 years. So instead of the typical age limit of 19 years for qualifying child, the age limit for the child tax credit is only 17 years. The child needs to be, underline, a US citizen, a US national, or US resident alien. For qualifying child, it was okay even if the child was a resident of Canada or Mexico. The child needs to have, underline, SSN or a social security number, which was not required for qualifying child. So for the child tax credit, the child needs to be a qualifying child plus must meet the 3 additional requirements. Now highlight refundable portion of child tax credit is also called the additional child tax credit, which is, put a box around, up to $1,400 per child. So what we mean here is, out of the $2,000 child tax credit per child, up to $1,400 is refundable. And then there is also, highlight the credit for other dependents, which is, put a box around $500 per dependent. This is other than for those, or other than for children for whom child tax credit is already claimed. Now under credit for other dependents, the taxpayer could have, underline, a qualifying child who is, underline, US citizen, US national, or US resident alien, but maybe does not meet the other 2 requirements for the child tax credit. Credit for other dependents could be for, underline, qualifying relative who is, underline, a US citizen, US national, or US resident alien and has, underline, SSN, ITIN, or ATIN. SSN is a social security number, ITIN is individual tax identification number, ATIN is adopted tax identification number.
Moving on to the E of ACE, which stands for education credits. Now, when we talk about education credits, we'll talk about two of them. Number one is the Hope Scholarship Credit, and the second one is Lifetime Learning Credit. Now, Hope Scholarship Credit applies for the first 4 years of college education. Expenses incurred there makes you eligible for credits. Lifetime Learning Credit, as the name suggests, is for lifetime learning. Now, education credits would be available for education expenses that you incur for yourself, your spouse, as well as your dependents. Now, let's say you've got a lovely wife who's a fashion designer, designs clothes for women. And looking at your wardrobe, she now decides to upskill herself. She also wants to learn designing clothes for men. The expense that you incur for her upskilling could be a lifetime learning credit on your tax return. Now, let's say you both of you also have a son who's into college. His expenses could be Hope Scholarship Credit. Now, if you're claiming the Hope Scholarship Credit for your son, in the same tax year, you will not get lifetime learning credit for him. So, for one dependent, one student, you could get any one of these in a particular tax year. So, guys, that is about education credits, the E of ACE.
On page 84, we're looking at education credits, which is right, the E of ACE. Here we have highlighted the American Opportunity Tax Credit, which was earlier called the Hope Scholarship Credit. This applies for student in highlight the first 4 years of college. This credit is highlighted up to $2,500 per student, where the credit is available for 100% of the first $2,000 of qualified expenses and 25% of the next $2,000 of qualified expenses. And this is highlighted a 40% refundable credit, which means that 40% of $2,500, that's up to $1,000, is refundable. The next credit out here is highlighted Lifetime Learning Credit. So as the name suggests, this is for lifetime learning and it applies to all members of family. It applies to highlight all years of post-secondary education, including courses to improve job skills. The limit for lifetime learning credit is highlighted up to $2,000 per taxpayer. The credit is for 20% of first $10,000 paid on behalf of all family members together. Now, draw an arrow for both these education credits, the American Opportunity Tax Credit as well as the Lifetime Learning Credit, and write either one for the same student. In other words, highlight the taxpayer cannot claim both the American Opportunity Tax Credit and Lifetime Learning Credit for the same student in the same year.
The D of DEARS is Dependent and Child Care Credit. Let me put that here. Let's see, you have a small child, a kid, and you want to go to work. To take care of the kid, you hire a babysitter. You send the kid to daycare. All these are dependent and child care expenses on which you may be eligible for a tax credit. So guys, if you realize until now, we've been talking about adoption, children, child tax credit, education, dependent and child care credit. And let's look at all of this on our book.
On page 85, we've got the dependent and child care credit, which is right, the D of DEARS. Now, this credit requires highlight care for a dependent child under 13 years, circle or highlight disabled dependent. This credit is provided to enable an individual taxpayer to be underlined gainfully employed, circle or at least underline look for work. The credit is highlight 20% to 35% of actual dependent care expenses, where the eligible expenses include highlight babysitter, nursery school, daycare, underline not grammar school. Now, these actual dependent care expenses are draw an arrow downwards to the third sub-bullet and write limited to highlight $3,000 in case of one dependent or highlight $6,000 in case of multiple dependents. So the credit once again is 20% to 35% depending on AGI levels of up to $3,000 if it's one dependent or $6,000 if the taxpayer has multiple dependents. Underline, if AGI is $15,000 or less, the credit is 35% of $3,000 or $6,000. And underline, if AGI is over $43,000, the credit is 20% of again $3,000 or $6,000 as the case may be. Let's look at the example on this page. It says John is a widower with 2 children. He's a working professional with an AGI of $60,000 for which applicable credit is 20%. His child care expenses include $3,500 for a babysitter and $5,000 for nursery school. And you need to calculate his dependent and child care credit. So we got $3,500 for the babysitter, $5,000 for the nursery school, total of $8,500. Now, given that he's got 2 children, 2 dependents, the maximum allowed deduction is $6,000. It's given that his eligible credit is 20%. So the amount of dependent and child care credit that John can claim is $1,200. So just put a box around $6,000 into 20%, that wants $1,200.
The first E of DEARS is earned income credit. Before we talk about this, it's important for you to know that this one's a refundable credit. Very, very important. So we know additional child tax credit, a portion of the child tax credit was refundable. We saw Hope Scholarship credit, a portion of that was refundable. But earned income credit is the most important refundable credit. And this is typically for low to moderate income groups who have a lot of qualifying children on them. So basically what happens is for those low income or moderate income groups, as they have more and more children, they get higher earned income credit. And let's talk about quickly how it works. So let's say I draw a chart and I say on the x-axis you have the earned income dollars, and on the y-axis let me put the earned income credit. Now as the name suggests, earned income credit, the credit is because there's earned income for the taxpayer or the married filing joint couple. So the earned income credit increases as the earned income increases. This is called the phase in of the EIC or the earned income credit. So as earned income increases, the earned income credit also increases till it reaches the maximum point. Then it flattens. The EIC remains constant despite increase in earned income dollars. Beyond a point, the EIC starts phasing out till it becomes zero. Because beyond this point, these are the rich guys, the high income guys. They don't need the earned income credit. So the earned income credit is not for the high income guys. It's for the low to moderate income guys, or the low to moderate income families. And it increased when the income was lower. It was increasing as the earned income was increasing. It's sort of at the maximum level for a period of time, and then it phases out. So this period is called the phase in. This one's called the phase out. Again, it's not really important from a CPA exam perspective. The dollar numbers again are not important, but what's most important for you to remember is that the earned income credit is a refundable credit.
On page 86, we are looking at the earned income credit. Put an E on the top. So that's the first E of DEARS. Now, earned income credit is underlined primarily for individuals and families who have low to moderate earned income. And a few lines below, it says both underline income threshold and maximum credit available increases with qualifying children. Now, let's look at the table that we have here. Though you don't need to memorize the dollar numbers, let's understand how this works. So if you look at the first column there, it talks about underline 3 or more qualifying children, and then you have underline 2 qualifying children, underline 1 qualifying child, and then underline no qualifying child. If you realize the dollar numbers are way higher if there are more qualifying children. They're the highest for 3 or more qualifying children. On the second column, put a box around phase in. And here the logic is, right, as earned income increases, the earned income credit or EIC increases. Between the second and the third column on the first row, put a multiplication cross. So the phase in dollars multiplied by credit as a percentage of earned income, right, equals the maximum credit. The last column talks about, put a box around phase out, where, right, as earned income increases, the EIC decreases. So as you can understand, the earned income credit is for individuals and families with low to moderate earned income. Now, they need to have some earned income to be eligible for the earned income credit. But if the earned income is beyond certain thresholds, the earned income credit reduces. Now, the EIC or the earned income credit is highlight a refundable credit and put a star there. And very interestingly, underline refund is given even if the individual has no income tax liability.
The second E of DEARS is elderly and disabled credit. So this credit is available to the elderly above 65 years or to the disabled as a certain percentage of their eligible income.
On page 87, the elderly and disabled credit is right the second E of DEARS. And this credit is highlight 15% of eligible income for individuals over highlight 65 years, circle or, and highlight permanently disabled. If the taxpayer is highlight single or only one spouse qualifies in case of married filing joint, the maximum base for this credit is going to be highlight $5,000. From the $5,000, subtract highlight social security income. Also subtract half of excess AGI over $7,500. The balance is the eligible income. Multiply the eligible income by circle 15% to get the amount of elderly and disabled credit. If it is a highlight joint return where both spouses qualify, the maximum base is increased to highlight $7,500 less social security income less half of excess AGI over highlight $10,000. The balance again is eligible income. Multiply that by 15% to get to the amount of elderly and disabled credit.
The R of DEARS is residential energy credit. So if you upgrade your US residence, your US home to use renewable energy, let's say you install solar panels or you install wind turbines or a geothermal heat pump, or you use fuel cells that rely on a renewable energy source, usually hydrogen, you may be eligible for residential energy credits.
On page 88, we are looking at the residential energy credit, which is right the R of DEARS. Now, this is 30% of eligible expenses if the taxpayer has made any of the following highlight energy saving improvements to the taxpayer's home located in the US. So the energy saving improvements may be via underline solar electric or solar water heating or small underline wind energy property or underline geothermal heat pump property or underline fuel cell property. So in all these cases, 30% of the expenses may be residential energy credit.
The S of DEARS, this one is savers credit, a credit for those who save. We also call this the retirement savings contribution credit. Now, for retirement savings of IRAs, individual retirement accounts, we spoke about adjustments or deductions to AGI, where you had IRA contribution as a deduction. Now, this deduction for IRAs was available only for the traditional deductible IRA. For Roth IRA, we discussed there's going to be no deduction. And the good news about Roth IRA, of course, was when you get the benefits, the distributions after retirement, even those are not going to be taxable. So the point is, for traditional deductible IRA, you get a deduction here, an adjustment to AGI, plus you also get a tax credit, the savers credit. For Roth IRA, you of course don't get the deduction here, but you still get the tax credit. Now, the savers credit also applies for your 401k plans, your pension plans.
Back on page 88, we're looking at the savers credit or the retirement savings contribution credit. This one's right, the S of DEARS. So the savers credit is highlighted up to 50% credit on a maximum of $2,000 for highlight contributions to traditional IRA or highlight Roth IRA. Highlight elective deferrals to a 401k plan or highlight contributions to an ABLE account by the taxpayer who's also the designated beneficiary. So basically, right, for traditional IRA contribution, the taxpayer is getting right deduction, and this was right wishes, and circle the I of wishes, IRA deduction. Plus tax credit. So a traditional IRA contribution, the taxpayer is getting a deduction, an adjustment to AGI, as well as a tax credit. For a Roth IRA contribution, the taxpayer right only gets a tax credit. Since for Roth IRA contribution, right, deduction is not allowed.
We've discussed that your gross income on Form 1040 is your worldwide income. So it's US income plus foreign income. Now, income that has been earned in foreign countries, the US citizens, US residents may have paid taxes in those foreign countries. Now, Uncle Sam allows a foreign tax credit for those taxes paid in those foreign countries. So when I talk about XDS equals foreign business winner, this F is foreign tax credit. So let's get back on the other side of my board. And as I go on the way, I'm sure you do realize that when we had looked at itemized deductions, I'd also said that you could take a deduction for your foreign taxes paid under takes. But of course, a lot of times you may prefer to take a dollar for dollar credit for your foreign taxes. So you have an option, either take a deduction here or take a tax credit out here. So this one is foreign tax credit. Now, for foreign tax credit, there's a limitation where this credit is the lower of the actual foreign taxes paid so lower of actual foreign taxes, or there's a limitation. This limitation basically is your US tax liability multiplied by foreign income divided by worldwide income. So let me put that up here and then we look at an example to understand this better. So US tax liability into your foreign income by worldwide income. Let's look at an example on the book to understand this better. It says calculate the foreign tax credit if your worldwide income is $100,000. So let me put $100,000 for your worldwide income. Then it says the foreign income included in above is $40,000. So what it means is out of $100,000, $60,000 has been earned in the US, $40,000 has been earned outside the US. So this one is $40,000. So basically about 40% of the taxpayer's income is outside the US. Then you have the US gross tax before the foreign credit is $30,000. So the US tax liability here is $30,000. So, and it says the foreign income tax, the actual income tax paid is $15,000. So let's look at this, right? So what we're saying is out of a total of $100,000 worldwide income, $40,000 is earned outside the US. 40% of the taxpayer's earnings is non-US foreign earnings. On the worldwide income, the US tax liability calculated for the taxpayer is $30,000. So $30,000 is the taxpayer's liability for the entire $100,000 of worldwide income. Of that $100,000 worldwide income, 40 is foreign. So now basically the taxpayer is paying 30,000 into about 40%, which is $12,000 tax on the foreign income. However, it seems that the foreign countries had a higher tax rate than the US in such a way that they actually charge $15,000 in taxes to the taxpayer. So even though the taxpayer has paid $15,000 of foreign taxes, he will get $30,000 into 40%, which is $12,000 as a foreign tax credit. That's his limitation. So look at this. This says, since $40,000 divided by $100,000, that's 40% of the total income is from the foreign country. 40% of the gross tax of $30,000 or $12,000 is the portion of the US gross tax applicable to the foreign income and is the amount of credit. So lesser of 15 or 12. So you're going to be allowed a foreign tax credit of $12,000. The remaining $3,000 that's not deducted this year can be carried over. So for foreign tax credits, you're allowed a carry back of 1 year, a carry forward of 10 years. Now let's change the numbers a little bit. It says if the amount of the foreign income tax paid would have been, let's say, 10,000. So instead of 15,000, let's say if this one's 10,000. Now it looks like the foreign taxes, the tax percentages in the foreign country is lesser than US. So the taxpayer has only paid $10,000 of taxes in the foreign countries. From a US perspective, the US tax liability is $30,000 on the entire worldwide income of $100,000. So the US tax liability on the foreign income portion is about 40% of $30,000, which is $12,000. So this one is $12,000. Now lower of 10,000 and 12,000, of course it's going to be $10,000. And therefore, if the actual foreign taxes is $10,000, what it means that there's another $2,000 on the foreign income portion that is payable in the US. Or in other words, you're going to get a foreign tax credit of the lower of the two, which is $10,000. So it says if the amount of foreign income tax paid would have been $10,000 instead of the $15,000, in this example, the foreign tax credit would be $10,000 equal to the foreign taxes paid.
On page 89, we've got the foreign tax credit. So on the top left, write F. So foreign income tax for individuals can either be taken as underline an itemized deduction, where the taxpayer can write deduct actual foreign taxes paid, no limitation. Or the foreign income tax paid can be used as underline income tax credit, the F of foreign business winners. Right there, lower of actual or limitation. And draw an arrow down. Highlight foreign tax credit equals foreign taxes paid. Circle subject to, highlight the foreign tax credit limitation, which is highlight the US tax liability multiplied by foreign income divided by worldwide income. Highlight foreign tax credit in excess of the limitation above may be carried over. Highlight carry back 1 year and carry forward 10 years.
Once again, HDS equals foreign business winner, and the business here is business credits. Now, these are credits awarded to small businesses, individuals. So, these are credits awarded by Uncle Sam to encourage them, encourage the individuals to do business, encourage the small businesses. So, let me put that up here, business credits. So these are a variety of business credits for various things. Let's say they are investment credits. Again, encouraging small businesses, encouraging individuals to make investments where they get investment credit. Let's say there's work opportunity credit, where the agenda is to encourage businesses, small businesses, to hire employees from targeted groups. Let's say there's a small employer pension plan startup cost credit, where small businesses get a tax credit for the startup cost of their pension plans. Again, to encourage them to set up a pension plan for their employees. Let's say there's a small business healthcare tax credit, where the agenda is to encourage small businesses to have health coverage for their employees by giving them tax ops, by giving them tax credits.
On page 90, we are looking at general business credits. So on the top left, write B. Now, business credits highlight applies to individuals who are self-employed, partners in a partnership, or shareholders in a S corporation. Now, business credits are highlight a combination of several credits that provide uniform rules for current credit and carryover years. Move to page 91 and highlight business credit limitation is limited to the net income tax less the greater of, highlight 25% of net regular tax liability above $25,000, circle or, and highlight tentative AMT for the year. So look at the example that we have here. It says assuming that there's no AMT for the year and net income tax is $150,000. Calculate the maximum amount of business credit that can be availed. For the first $25,000 of tax liability, allowable business credit is 100%. That's $25,000. For the excess over $25,000, so the excess income tax over $25,000, up to 75% of that amount can be claimed as business credits, which in this case is $93,750. Which means that if the net income tax is $150,000 and we assume that there is no AMT, the maximum business credit that the taxpayer can claim is $118,750. Now, in case the taxpayer has any highlight unused business credits, they may be carried over, highlight carry back 1 year and carry forward 20 years.
You HDS, you're going to be foreign business winners, and our W winners, that's withholding tax. So let me put that up here. Now, withholding tax is basically not a tax credit, it's actually a tax payment. It's a payment made on your behalf to Uncle Sam. So let's say if you're working for an employer, the employer withholds taxes from your paycheck and remits to Uncle Sam every month. And the employer at the end of the year is going to give you a form W2 with all the details of the amount of compensation payable to you amount of compensation paid, and how much taxes have been withheld and paid to Uncle Sam. If you've been an independent contractor, from your client, you'll get a form 1099 again, which would have the amount of taxes withheld by your client and remitted directly to Uncle Sam. So all these are typically tax payments made on your behalf. And of course, if there's extra payment made, you could claim a refund back from Uncle Sam. So it's refundable because it's a payment. Here we also talk about any excess FICA. Now, there's payroll taxes deductible from your paycheck every month. Now, if you've worked for multiple employers during the year, it may so happen that there's extra FICA deducted from your paychecks. Reason being, for the social security portion of FICA, there's a particular dollar limit. But if you work for multiple employers, maybe there's FICA social security paid in excess of the dollar limit. That excess FICA paid would be allowed to you as a tax credit. It will be allowed to you as a credit against your federal income tax. So guys, with this, we are done with your tax credits, the dollar for dollar reduction of your taxes.
Back on page 91, we are looking at withholding tax as well as excess FICA. Put a W there. Highlight withholding tax, the paycheck credit. These are income taxes withheld and paid directly by the taxpayer's employer. And it is highlight treated as a credit against the taxpayer's liability. Now, this is highlight a refundable credit, as a refund is generated if the withholding exceeds tax liability. So right there, form W2, that's issued by employers to write employee. And if the individual is an independent contractor, the individual would be getting form 1099, which again is for independent contractors. Now, just in case from the employee's paycheck, if there is highlight excess FICA or social security tax withheld, and this could happen if an employee has highlight 2 or more employers during the year, the excess FICA highlight may be claimed as a credit against the income tax.